Hey everyone, this is Mike at DSR. I hope you're doing well. We're going to start in a few seconds. I'm just letting other people's logging in. I can see that there's a lot of people right now coming in. So if it's your first webinar, I'll give you just a quick tour. On your left side, you have the comment box. As you can see, there's a lot of people that are already starting using it. So whenever during that presentation you have a question about what I'm saying or about what is being displayed, you just have to key it in. If you have a more specific question or a longer one, just use the question section at the bottom right there. So at the end of the presentation, I will stick around to answer all your questions. So it could be in regards to the retirement portfolio, but it could be also a general question about a specific stock or a strategy that you want to know a little bit more about. Hi, Rich. Hi, Dave. Hi, Darren. So I can see that we still have a lot of people from hello, René. A lot of people from Canada. We have a lot of people from US as well. We're going to cover both portfolio today. So don't worry, regardless if you're Canadian or US, content will be about the same thing. Hello, Mark. So there you go. Okay, so we're going to start. I guess that the sound is doing well. We also have Vero. Hello, Vero. We also have Vero with us today. So if you have any technical problems, she'll be able to walk you through. So thanks, V. So we'll go ahead and discuss this portfolio, retirement portfolios. So why you're here today, this one is a first of a series of 3 webinars. Actually, I did a free one 2 weeks ago, more about retirement mistakes, and now we're going to go deep inside the topics. Those webinars are exclusive to DSR members, so nobody, it's not open to public, even though you're registering to my regular webinar. This one is just for you guys. I think it's important to give you a little bit more value over there. So this is why we are going to use a lot the DSR tools as well. I'm going to present you both retirement portfolio, how we have built them. We're going to discuss the selection process, asset allocation. This one is maybe a little bit more general than the next 2 webinars we're going to do not in August, but in September and October, where we're going to discuss the payout ratios and withdrawing strategies and so on. But then we have to start somewhere. You're here to ask all your questions. As I mentioned, you just have to use the question section down below. I'll stick around for 20, 25 minutes, maybe half an hour if there's a lot of questions. As usual, you're not here to get buy or sell recommendation. Everything that is being mentioned or shared by Dividend Stocks Rocks or myself cannot be taken as buy sell recommendation or financial advice. You cannot sue us if you're losing money on the stock market, but on the good side of things, you won't have to pay us a dime if you're making some money. Yeah, I guess you probably know me, but I'm just going to do a quick introduction, which I usually do in my webinar. Just so you know, why should I listen to this young guy? What does he know about retirement anyway? I've been a financial planner for several years. I've worked in the financial industry since 2003 and did a portfolio management, retirement planning as part of my job at a wealth firm and at a bank, actually. Used to work for National Bank, if you're wondering which one. So I was a financial planner and a private banker for about 8 years. My job was mostly to do retirement plans, manage portfolios for wealthy individuals. So we're talking about 6-7 figures portfolios. I've went through the 2008 crisis so with my clients. A lot of them were panicking, obviously, but while most advisors were hiding under their desk, I was picking up the phone and calling everybody to make sure that they understand what's going on and understand as well that even though you've worked your whole life and you're now afraid to lose all your money, this is just a quick storm and then it's going to fade away. It's kind of funny because it reminds me, yesterday night we had a thunderstorm in Quebec. And my youngest kid, Caleb, he's 6 now, and he didn't want to go to sleep because it was around 8 p.m. at night, and he was just afraid. And I just told him, well, you know what? If you just wait like 15, 20 minutes. Your sister's over there as well. She's reading, so she's not asleep. We're downstairs. Just wait. Keep the course. Just go inside. You can play with your toys. And then in 15, 20 minutes, the thunderstorm will be gone, and then you can fall asleep. And this is exactly what happened. So basically, my role was to take my client by the hand and make sure that they don't fall into emotions and panic. And this is a little bit more what I want to do now at DSR, but the difference is that I'm able to help thousands of investors instead of a few hundreds. So the key element here is to remember why you have worked so hard and why you have built this portfolio. When you're about to retire, or if you're retired already, you have to write down your investment plan. You have to remember what's happening, because a lot of people are telling me, and a few days ago, one of DSR member, he sent me a note and he said, well, I have 70% of cash right now, and it's been going on since 2015 because I thought that the market crash was about to happen 3 years ago. And I don't know if you remember, but back then there was the or in the oil industry, there was a crash. So the oil barrel was going down between 2014 and 2016. So energy sector was not doing very well. And both in 2015 and 2016, we had like those small, I would call them market crash, but it's just like a small drop of 10%. Temporarily over a few weeks, and then it was back up. So during those small episodes, a lot of investors thought, well, this is it. This is like the next 2008. The market's going to crash, and then we have to get out. But the problem is, again, we never know when the market is going to crash. So the best way to build your portfolio and to manage your retirement portfolio is to stay invested and to aim for safer stocks. How do you find safer stocks? Because this is easy to say, but it's a little bit harder to do in the real world. And this is what we did with our portfolio. We were looking at stocks that were paying at least 3.5% yield. Most of them were around 4 and 5. As you can see, the goal was to create portfolios generating nearly 5% yield. So most of them are between 4 and 5. But those companies must show as well growth vectors. You want to make sure that those companies are able to grow in the future. You cannot control the market. You cannot know when the next crash is coming, but a good company remains a good company. Those businesses will go through the challenge, but they are strong enough to go through it, to keep increasing their dividend, and reward you later on with some capital appreciation. So another factor that we looked at when we built our portfolio was to look at companies that had stable business. This is why in both portfolios, we don't have much energy stocks. The reason is not that energy stocks are bad or that they should not be in your portfolio, but the problem is they are highly dependent on the oil price, obviously. So what happened is it's always a great time to buy them when the oil price is low. And then when it goes back up, there's always a surge in earnings and in revenues, and everybody's saying, oh, it's great. They raise their dividend, everybody's happy. And then all of a sudden the cycle goes again, and then dividends are being cut. So this is why we didn't want to put too much emphasis on the energy sector, even though there are like great opportunity over there. Our goal was to build a portfolio that will last 20, 25, 30 years from now. And we started them a month ago, so right at the top of the market, not knowing if the market is going to crash in 3 months or not. They all share another very important point, is dividend growth. And I'm going to show you why we focus so much on dividend growth at DSR. It's not because it's and is related of the name, but most likely because this is a key differentiator when the market goes bad. So what you see here is a result of a research from Ned Davis Research. Actually, you probably saw a similar graph. It's going around for many years now. So this institute did tracking performance for companies that either don't pay dividend, that cut their dividend, or they increase it, or they don't change it at all. So what you can see is obviously dividend growers and initiators, meaning that companies that started at one point to pay a dividend or keep increasing it throughout those years, have outperformed the rest of the market. When you think about it, it's quite logical, because companies that are able to distribute a part of their profit with their shareholders means that they have growth vectors, because their business is growing, their revenues are growing, and their earnings are growing. Therefore, they have more money in their pocket and they can share it with investors. When you put all those factors in together, this is what I call the dividend triangle. So revenue, earnings, and dividend growth. When you have the three combined together, obviously you have a strong business, because management would not risk the company's balance sheet and financial health just to make investors happy over the short term. So this is why it is so important to focus on companies that are able to grow their dividend, because as a retiree, you will use a lot more the dividend payment than the capital appreciation. So you don't really mind if in 2 months or a year the portfolio is going to drop. What is really important is your income source keep going and keep increasing. We want to increase it as well because we want to cover inflation. Just to mention, it's exactly the same thing that we see on the Canadian market. So this graph has been produced by RBC Capital Markets, and you can see that roughly dividend growers are outperforming the TSX, and they're outperforming simple dividend payers. So just to say that it's not just the US market that is like that. Chances are that if we had stats from the European market, we'll probably see the same thing, because it all goes down to the same concept of having a growing business with growing revenues and obviously growing earnings. And now I want to share you a story with you, because at the beginning of DSR, and you know that we are going to celebrate our 5th anniversary not in October, sorry, but in December. At the beginning, we were focusing a lot on dividend growth, and we still are. And we were leaving a lot of high yielder aside, because we didn't want to select any companies paying yield over 5% back then. And one of my reader, he sent me an email and saying that there's a lot of great opportunities among higher yielding stocks. So I thought that was quite interesting back then. So I asked him, well, why don't you share with me 4 companies with high yield, and then we can compare with our DSR starter portfolio. So I didn't want to cheat or anything. So I'm like, you know what? We already have a book of like 4 stocks. So let's compare both aside and see what's going on. So when I did that, from what I remember, it was in 2014. And interesting enough, the combination of those 4 companies, the 4 high yielding stocks, actually showed better, not only better yield, but better overall return compared to the DSR portfolio. And then I just waited a few years and decided to go back and see what's happening. And what happened is this. What you see here is the selection of Kinder Morgan, Starwood Property, and Ares Capital REIT. And the 4th one actually was Breedburn Energy Partners Limited, and this one was down by 90% and eventually disappeared from the stock market around 2016 during the oil crisis. So what I want to show you here is the reason why we do not focus on high yielding stocks, even though we've built retirement portfolios, is we took 4 great companies, and I'm sure that a lot of you guys know about Kinder Morgan, but 2 out of 4 just lost most of their value. And then the other 2 are showing some great returns, right? We're talking over the past 5 years, we're talking about total return of 62% for both Starwood, and Ares. But when you look at the dividend payment, this is where it doesn't get very interesting, because The first one, Kinder Morgan, cut their dividend by 50%. This means that actually it was more than 50. Now we're up to 50 because they start increasing the dividend again. But keep in mind that if you have selected Kinder Morgan or Bridgeburn Partner as a source of income, you're left with not much money out of it. If you selected Starwood or Aris, and Aris is just at like two small dividend growth, like a small special payment. So basically, those two didn't grow their dividend, their payment by much. So overall, you might generate a higher yield, but first, your dividend is at risk. And the second thing, which is even more important, is those dividend payments cannot keep up with inflation. So what's the point of building a portfolio generating 8% or 9% payment? And then in 10, 20 years from now, you're still stuck with the same payments or barely the same thing. So basically, your cost of living is increasing, but not your source of income. So eventually, you're just losing money anyway. It's just that you don't see it. So you have to take those two factors into consideration. And this is why we opt for stocks paying 4.5% yield most of the time, but to have better growth opportunities and capital opportunity appreciation as well. Another important factor is asset allocation. I've repeated that many times, but this is one of the reasons why we don't, at DSR, we try to never go over 20% for any sector. For the retirement portfolio, we had to make an exception and put 25% in REITs. Mostly because it was very hard to find a great balance between high-yielding stocks and different sectors. However, as you can see, we have over here 1, 2, 3, 4, 5, 6, 7, 8 sectors across 20 stocks. So it's well diversified. The whole purpose over here is to make sure that we don't get into problems because there's a one specific sector that goes south and then all your portfolio is gone. I know a lot of retirees are investing a lot more in REITs, but there's your problem. If there's a problem with the sector, then your whole portfolio would be at risk. So if REITs are going through a challenging period and there's a lot of dividend cuts over there, you want to make sure that you don't have 50% of your portfolio invested in this one. I wanted to share with you also the 5 years dividend growth for the US stocks. Then we're going to look over the Canadian one. Obviously, I'm not going to spend the next 50 minutes talking about all those companies, but I wanted to know if you were surprised or if you had any questions in regards to those selections, if there's any companies you would like me to discuss a little bit more. So you can use the comment box on your left. Just put the ticker and I'll go maybe like 2 or 3. While you're thinking about it, I might want to discuss a little bit Blackstone. This is the first one on the screen. The reason why we selected this one is because the company is alternative asset manager. They have over 400 billion under asset under management, and they focus on not on equities, but on alternative assets. So this is what I like about this one. It's a little bit different than the usual investing manager. The other thing that I really like is that the CEO of this firm makes most of its money from dividend paid by Blackstone. So he owns good shares of it. So his interest is directly aligned with yours. He wants to make money out of it. Last year, he made nearly $800 million and about, I think it was like 500 or 600 million were dividend paid. So the dividend will go up and down all the time. It's important to remember that, mostly because they're paying according to their distributable cash flow. So depending on if they have sold an investment or they're making a good profit, this is where you're going to get a higher dividend. Vero, you're asking me, did you take upside potential into consideration for the picks? Yes, we did. Obviously, some of them seems mostly fairly valued because it's hard to find 20 stocks that are undervalued right now, and on top of it, paying high dividend yield. But most of them have growth vectors. If you click on each of them in the portfolio booklet, you will be able to get the stock card and see how it works. So just want to make sure that you remember how to get it. I'm going to share my screen for a moment and walk you through DSR. So there you go. So if we go on DSR, and my internet connection is slow this afternoon. If you click on portfolio, what is interesting, that is an update that we did about 2-3 weeks ago. You'll get access to all our portfolios, so US and Canadian. So you can click on here, or you can just follow the regular path. So it will bring you both to the same place. And where you get to the retirement portfolio, you will get obviously this is an Excel format downloadable spreadsheet, and you can also get the booklet. So by clicking in the booklet, you'll get all the information that I was discussing about the asset allocation. You'll get also, obviously, stats right now are empty because the portfolio has just started. And then what is interesting is whenever you want, you can click on any of those companies. So if I want to learn more about Lazard, I click on it, and there you go. I have my stock card over here. So if there's, I'm just going to go back to my screen right now. So if you have any questions in regards to any stock picks, you can always look at them at that place. Carlisle, you're asking, do you recommend any particular amount of capital to start this portfolio? Not necessarily. I mean, you have 20 positions, so if you want to make them count, at least you have to put, I'd say, $1,000 in each of them, mostly because those kind of transactions will cover your fees. This is probably the thing that is the most important thing. I mean, if you want to invest $500 or $300 per stock, then you're going to have a problem. We decided to use 20 companies in both portfolios, thinking that a retirement portfolio will probably hit $100,000 and more, but you can definitely use it with $25,000 as well if you want to build an income reliable portfolio, or if you want to invest for your children's education, for example. Those could be you can still use the retirement portfolio for that thinking as well. The purpose here is just to have, like, what we did is that we have equally weighted portfolio, and we're going to use on this one, we're not going to withdraw the dividend payment. We're going to use the dividend payment and future trades to balance the portfolio when it happens. But always take for granted that those portfolios, all DSR portfolios actually are showing equally or almost equally weighted stocks. More options for US investors, I would probably go with Canadian banks and Canadian telecom. So if there are a few companies that you don't really like, or you would like to have a better exposition to higher yielding stocks, for example, I know that a lot of US investors will go with Verizon or AT&T. If you look on the Canadian side, actually BCE and TELUS both trades on the US market, but they show very interesting dividend yield, and they also show a higher dividend growth rate than Verizon and AT&T. Karen, you're asking, is it a retirement portfolio? Why wouldn't you assume that people will want to withdraw the dividend? No, it's just for managing purposes, actually, just to manage the portfolio on our side. This is why we don't withdraw the dividend when we do our calculation. But obviously, as a retiree, you will definitely withdraw the dividend on your hand. That we understand that, just that you equally weighted it. We're going to discuss about withdrawing strategies on the webinar in October. We'll go deeper into that section and explain how you can withdraw money from a retirement portfolio. So now moving on the Canadian asset allocation, this one's a little bit different. In Canada, we had the luxury of having a very strong banking system with stocks paying high yield. So this is why the financials is a little bit higher. As you can see, I only put 10% in energy stocks for the reason I mentioned before. I didn't want to have it moving up or down too fast. We also have communication services, so Bell and TELUS that are part of it. Obviously, for the same reason, strong players working in evolving in an oligopoly, so not many competitors, well protected by the government and regulations. So it's a lot easier for them to grow their business, be profitable, and then charge us an arm and a leg for cell phone packages, and still distribute some income out of it. As you can see on this one, over the 5 years, most of them have increased their dividend payment as well. That was the whole purpose. I want to make sure that this portfolio doesn't only generate, this one is close to 5% yield, but can keep up with inflation over time. So this means that your payment will increase year after year, and then you're going to make a lot more money. As you can see, Boston Pizza shows a very, very small dividend growth rate because it doesn't increase its dividend year after year. It's not the end of the world if you have like one or two companies that like this in your portfolio, but the purpose is to make sure that your overall portfolio stay up with inflation. So for one or two REITs that don't increase their dividend, I mean, it's acceptable, especially in the case of Boston Pizza with a yield that is close to 7%. It's quite appealing in terms of revenue, and it helps balancing out against other companies like Fortis or TD Bank, for example, paying around 3%, 3.25%, which are lower rates. So when you add both of them, you're getting something a little bit better as well. When we released those portfolios, a lot of people were saying, well, why should we go 100% Canadian? All your other portfolios shows half US, half Canadian. I would definitely, like, even for my own personal portfolio, retirement portfolio, I will not go 100% Canadian. I think that it's important to use the diversification factor that US stocks can give us. Companies, we don't have like companies that are international as we can find on the US market. So for one, this is a very good reason to do it. Currency factor isn't very important in my opinion, because you're going to use this portfolio for several years. Even though you're 65 today, chances are you're going to live up to 85 to 90. So basically you're going to use this portfolio for at least 20 years. And when you look at the currency fluctuation over a long period of time, it doesn't really affect your portfolio return. Worst comes to worst, both Canadian dollar versus the US will move for about 30%. That's probably the worst case scenario that could happen. So 30% over 20 years, you're not even at inflation rate. So therefore, you're better off with a better diversification, companies that are paying strong dividend yield and increasing it, than trying to go after 1 or 2% for the currency factor. The only thing is, don't look at your portfolio on a yearly basis, especially for the value, because you're going to see big swings from time to time. For example, when I started investing in US stocks, it was back in 2011, 2012. The Canadian dollar was at par, sometimes even a little bit higher actually than the US dollar. So my first years going forward, when I looked at my portfolio between 2015, 16, then it was showing a very strong upside because just the conversion was making a lot of money, but that is just temporary. And when I look at my portfolio today, 6-7 years later, the currency factor isn't that important anymore. So probably that 50% of your investment in US and the other 50 in Canadian could be interesting. It just gives you a little bit more options. because you have now 40 stocks to look at. But I would definitely go for something in between instead of going all in for one place to another. It's also good for U.S. investors, but fortunately, you have a lot of diversification on your side. However, a few banks and telecoms would not hurt. Companies also like Enbridge, for example, could be a great addition to your portfolio as well. In the next two webinars, I hope you enjoyed this one. If you have any question, we're going to move towards the question section in a few minutes. I just want to tell you what's going to happen in the next webinars. The one in September will be a lot more technical. We're going to go a lot deeper into the dividend safety. So we're going to discuss price earning ratios. We're going to discuss the payout ratios, cash payout ratios. We're obviously going to look at REITs and how we calculate the funds from operation ratios as well. So we're going to basically look at how we determine if a company will keep paying that dividend, try to make sure that the dividend safety score is good on those, and that you can keep up going forward. And then in October, we're going to discuss about withdrawing strategy, because it's one thing to build a portfolio. It's nice, it's solid, it goes through the market crash, but then you want to make sure that it can go through that you know how to withdraw that money. We're going to discuss a little bit tax efficiency as well. I'm not an accountant, but I'm going to give you a few tips where to look at and how to get the best strategies for that. Before I go to the Q&A session, I just want to mention that a good way to prevent having dividend cut in your portfolio is to track your portfolio on a quarterly basis. Just want to let you know that we offer this service at DSR Pro. This is basically an upgrade to DSR. So I know that we have some Pro members among us. What we do is that we track all your portfolio on a quarterly basis. So the next report will be sent during the last week of September. We go through the whole earnings reports. I'm going to show you what it looks like in a second. I'm just going to share my screen and show you how we do it. So basically, once you subscribe, you will have to fill out a form like this. So you put number of share, the ticker, and the company name. So what we do after that, we create a big report giving you actually a rating for exceptional buys, buy, hold, sell, and screaming sell. So you have a big a great overview of your portfolio with your asset allocation. You also have comments. So if in this section, actually here, we're going to tell you which company is rated as a sell or a screaming sell. And a new update for existing DSR Pro members, actually, a new update in the report for September, you will get what we call, sorry, I'm going to get back to my screen because I'm getting lost right now. You'll get a summary of all stocks in one page. So you'll see if, for example, Bell, the ticker, the pro rating, the dividend safety. So you'll get everything in one chart, so you can quickly act on each of them and make sure that if we say, well, I think you should look at Bell because the dividend safety score has dropped to 2, and now it may not increase or potentially even cut their dividend at one point. So this is the kind of thing that that we track for you. You're able to have up to 40 stocks in your portfolio. If you need more, we also offer other packages, so you can let us know if you need more. So just if you're not a pro yet, we're closing the doors because basically we're tracking now nearly 1,000 stocks. So we don't want to keep going them forever. So on October 31st, we're closing the doors, so all pro members will get the report. The others will have to wait until the next one that will be around December or January. So just click there. You'll have an explanatory video as well, so you have more information about pro. I'm going to put the link over here. So this goes on top of your subscription. If you want to combine both subscription, we can do that as well. Just send us a quick email and we'll put your existing subscription, do a prorated refund, and then combine them together. But it's a great way to track your portfolio and avoid potential disaster. So then now I'm going into the Q&A session. So if you have any questions in regards to the retirement portfolio or anything, I can see that there's a lot of questions coming in. So just use the question down. I'm just going to answer Karen Hall first in the comment, and then I'm going to move towards the question section. So Karen, you're asking, have you considered a portfolio that is 50 Canadian, 50 US, but with fewer than 40 stocks, let's say 2025? That's a very good question. It's kind of funny because it's exactly what I would do. If I had to start a retirement portfolio today, I would go 50-50. But I haven't built one. So maybe I could do a combination. What would be important here is to make sure that you have a similar asset allocation. So probably keep investing between 7 to 8 different sectors, making sure that you cover several one. And when you go into REITs, for example, a good way to improve your diversification, if you have 25 or 30 or even 35% of your money invested in REITs, is to select different subsectors. So for example, EPR Properties on the US side is investing into movie theaters complex, into water slides and golf complex as well. So this is more looking at entertainment. It's a lot different than if you look at City REIT on the Canadian side, where they are hosting mostly Canadian Tire stores. Or for another example, Granite REITs in the Canadian side, which is an industrial warehouse REIT. Most of their income is coming from one tenant, which is Magna International. So it's completely different, 3 sectors, but still all invested in REIT. So this is how you can a little bit play around it. But I'm gonna take a note of that, see if I can do something like a 50-50, but not necessarily track it, but just to give you an example of what it would look like in a newsletter or something. So it's good feedback. Thanks you for that. So now, Bruce, what are your thoughts on including U.S. managed limited partnerships in a retirement portfolio for a Canadian citizen? Bruce, that's a very good question. With DSR Pro, I can tell you that we've gone through a lot of partnerships, limited partnerships in the U.S., and I am not quite sure I would put too much money into it, regardless if you're Canadian or US. The problem with those companies is they are capital intensive. They need to basically issue more units to fund their projects. And this thing works as long as there's an appetite for more units. So you can raise debt and then you can raise units. And if you invest it into new project, you're able to generate more money and distribute about the same or even better money per unit. But the problem is it's only as good as there's an appetite on the market for that. So if you're issuing new units and then there's a problem because people don't want to invest more in limited partnerships, then you're going to get stuck and you won't be able to go ahead with your projects. Then again, also very linked to the energy sector. So for those reasons, I don't want to put too much money into this one. Rich, you're asking, Mike, what is the best way to do kind of research that you do? Can I do it as a layperson? Where do I start? Do I need to pay for access to information? Do I need to read all the company's annual report? I just don't know the best way to do any of that. Could you make a couple of recommendations? The research that we do is basically, we're using like 2 tools that I would say, two main tools. The first one is you need access to lots of data information that you can filter. Personally, we use Whitechart. We have obviously a professional membership over there. It's quite pricey. We're talking about a few $1,000s a year to access all the information, but this is how we're able to quickly screen the market, put all the requirements we're looking at, all the metrics. So if I want to take a look at a company showing like 5, 3, and 1 year growth rate for dividend, revenue, and earnings, and then look at payout ratio and cash payout ratio, I can put everything in the same screener. They can sort pretty much all kind of economic data as well. So I can take a look at the GDP or the oil price, and everything is being from the same data source. So this is why we have chose Whitechart. It obviously takes a lot of time. We have a few employees. We just hired a new writer as well at DSR. So obviously you're comparing like individuals, investor resources to a small company. So this is why it could be very hard. And the other things that we do, the second tool that we do is that once we have selected companies that we like, well, we actually go through annual reports and quarterly reports, because numbers are telling you a part of the story, but the real story is found into annual and quarterly reports. For example, if you look at most charts right now, if you pull out the stock cards that we do, and you look at EPS, earnings per share graph, a lot of them are moving in important matter in 2018, mostly because of the tax bill. So some of them increased their profits, some of them dropped because they had to put a tax provision, stuff like that. So there's a lot of difference. And then, you know, when you see one of the three metrics, so dividend, revenue, or earnings going up or down for no reason, then you need to go through the quarterly sector and the annual report to understand what's the story behind it. This is the reason why we have created DSR Pro as well. By following all those companies on a quarterly basis, we are able to tell you what's happening, because we're all happy when you have an earnings jump of 50%. But then you have to understand why, because is it recurrent? Is it a new thing? Is it because the company had previously sold or purchased another competitor and now revenues are going up like there's no tomorrow, but then the next year it's just going to be regular revenues. So you need to look at organic growth and stuff like that. So it's a little bit hard to do all this research by yourself. And this is why we have created DSR and DSR Pro. So if you want to use our service, what I would suggest you to do is to start with the portfolio. Maybe go back on the dashboard member. So click on the member when you log in. You have all the steps. So select your portfolio, look at the rankings, and then read the stock cards to make sure that you pick the companies that you like. So you'll have a summary. The stock cards is a summary of our research, because our goal is not to produce 50 pages of content per company. I know some investors are very analytical and they want to have lots of data, but this is not what we do here. Our goal is to save you some time. So we want to make sure that we provide you a condensed resume of what we have found on that stock. And then with the newsletter that is coming out on Fridays, you're able to follow market news and then able to trade, buy or sell other stocks. So this is how it would go. And actually, this is exactly what I did last year when I quit my job at the bank and received my pension fund. What I did is that I followed those steps using DSR, and this is how I built my pension portfolio. I'm putting updates on it on my blog. And actually all my holdings are part of DSR stocks that we have in our portfolios. René, you're asking, in the Canadian portfolio, although the numbers are improving, tell us more about the choice of Exchange Income Corporation. When short seller Mark Hoodies runs around the company, it's never too good. You're right. Actually, I was looking at this company and thinking, you know, I like the fact that they're growing through acquisition. I like the dividend growth, but on the same side, the company isn't. It would not be my first pick. in a portfolio. Obviously, the thing that I like on this one is mostly its high yield, and the fact that even with limited growth, dividend growth, we still have a valuation that is interesting. So I think that the company will be able to go on, and the whole aerospace industry is going well. So for a company that is offering supports for this sector, I think they will be able to go through this. Sorry, I'm losing my words right now. Through this tailwind. But obviously, do not expect a huge capital appreciation right now. But it's been a few years that the company is stable and it's still increasing its payout year after year. So I think that we're going to have here a good income generator, not necessarily a huge winner in your portfolio, but as the goal is to distribute income, Exchange Income Corporation will be, like, the dividend is safe and will be able to maintain that dividend for a while. So this is why we have picked it in our portfolio. Dave, you're asking me, have you investigated Capital Power Corporation on TSX? No, I haven't. So I'm going to take a note on this one. I'm not quite sure. No, I don't. This name doesn't tell me anything. So I'm going to take a note and take a look at Capital Power Corporation. Karen, you're asking me, how do you anticipate communicating changes in the portfolio quarterly or on a more random ad-needed basis? As it's the case with all the other portfolios at BSR, what we do is that we review each of them on a quarterly basis. We update our booklets on a quarterly basis as well, and we do our trades at the same time. All those changes are being sent through the newsletter on Fridays. So whenever we make a trade, it will be mentioned in the Friday newsletter. So either it's a commentary or just a classic issue. It will be sent in the email, and then we're going to send you a reminder of those trades towards the end of the month. Most of the time, what we do is when we take a decision, so let's say tomorrow morning we're the 17th, and we take a decision that we are going to sell one stock and buy another, this transaction will be sent on the Friday, but it will be performed at the end of the month, so the last day of the month. We do that because we do all our trades at the same time in our portfolio, so it gives you more time to keep up with what we do on the in the portfolio and make the same trade actually. And because we don't really think about market timing, so if I make a decision to sell or to buy a stock on the 17th, it doesn't really matter what's going to happen, and I'm still going to buy it on the 31st of the month. So this is why we decided to do it that way. So on each Friday, you will receive trades alert, even though also for the retirement portfolio, and we will also update all commentary on each position on a quarterly basis. Karen, you're saying, what is the story on stocks in the portfolio that shows a payout ratio well over 100? This could be in regards to several factors, actually, and this is why I want to do a whole webinar about that. Payout ratio, first thing is it's based on the dividend paid divided by the earnings per share, right? The earnings is a number that is being calculated based on accounting principles. It's not real money. For example, if there's, like I mentioned earlier, due to the tax bill in the US, a lot of companies had to take a tax provision for something. So it's a one-time event. But obviously, if you're taking a 1 billion tax provision, your earnings per share for that quarter will be off. And then what's going to happen is that throughout this whole year, the next 12 months, you're going to still keep that weird payout ratio because your earnings will be very low. So for that reason, you need to go a little bit deeper. Another thing, if you're considering anything like limited partnerships, REITs, BDCs, those are not working on earnings. They are working on distributable funds, so funds from operation. Same story with Blackstone. Since it's an asset manager with sometimes their investment are not that liquid, they go with distributable income instead of the classic payout ratio. So the payout ratio is interesting, but it doesn't tell you much of the story. Right now, we have like several companies that are doing amazing. Like from what I remember, one like Microsoft that is not in the retirement portfolio. Microsoft is doing very great, but right now the payout ratio is like through the roof because earnings dropped for accounting reasons, not because they have less money on the account. So this is why you have to go through each of them, look at the quarterly report or annual report to see what's happening. But I'm going to show you that in the next webinar, because it's going to take pretty much 30 to 40 minutes just to go through all of those situations. Peter, you're asking me what factors goes into determining the total yield of a company. Do you mean the total return or the yield that the stocks is going to pay back? Can you just like use the comment box or just add more information on your question? Just want to make sure I understand it correctly. I'm just gonna wait until you get more information, and I'm gonna answer the other question in the meantime. Dick, you're asking to take some of the volatility out of the energy stock. Would you add a preferred stock like ENB.PFK to your portfolio? Yes, actually, that is a very good idea to add either bonds or preferred stocks. We don't cover them in DSR because those are two different beasts. But obviously, preferred stocks, what is very interesting is they act more like a bond than a stock. So you obviously have a more stable value. The downside of it is sometimes they are less liquid than stocks. So maybe you want to look at an ETF that is aiming at preferred shares. So then you will get the yield, you get the stability, but you can quickly buy or sell it. So that could be interesting as well. But definitely, if you want to add more stability in terms of value fluctuation, not having 100% stock portfolio will definitely help. The yield column, yeah. So if you look at the yield, I'm just gonna go back. Well, just the Canadian one. The yield is just when we actually make the selection, because this is always going up and down. So basically, it's just the dividend divided by the price stock. So that was the current yield about a month ago when we built the portfolio. So obviously, this is moving all the time. We're going to update that in the portfolio booklet as well, because it's very important. But keep in mind that depending on what's happening on the market, if we have a great run and the stock market goes up by 10% in the next month, for example, if you look at the retirement portfolio yield, we might be closer to 4.5 or 4.2 at that time than versus when we build the portfolio 2 months before. So obviously this is always changing. The idea, this is why we looked at something between 4 and 5% as portfolio, but it's going to keep moving up and down. Obviously, if a company is showing a yield that is too low at one point, this will be a good reason for us to sell it, just to keep something that is always up to date and not to get in 2-3 years from now having a portfolio generating 3% of income, because for new members it will not make sense. So for example, on this one we have Fortis paying only 3% yield. If Fortis has a great run and the dividend payment doesn't increase as fast enough and it goes down to 2.5, most likely we're going to sell it and buy something with a higher yield. D, you're saying that we have Enbridge in our Canadian portfolio, but not in the US. Why? The only reason, and even I discussed this in the webinar, is that I think that Enbridge could be a very good addition for US investors, but I wanted to create it two pure portfolios. So even though Enbridge, like Canadian banks or telecoms, are trading on both markets, this is why I didn't pick Enbridge, because it's a Canadian company. I know that Brookfield is in there though, but I didn't want to put too much emphasis on Canadian stocks trading on the US market. But that's basically the only reason, and because we were able to find other great picks on the US side. But basically, that's the only reason. If not, I think that Enbridge is good for both. I mean, I do own shares of Enbridge. So personally in my portfolio, I think it's a great company. I think that now that the Line 3 replacement has been approved and they're moving forward, we're going to get that 10% dividend growth year after year that they've promised for the next couple of years. And we're still going to have a great run on this one. So regardless if you're American or Canadian, I would definitely go ahead with this one. But I had to make choices when we did the portfolio. It's not, at one point, it's not like one stock versus the other. It's just both together at the same time. Mike, you're asking what are most undervalued sectors at present time? Very good question. I think that everything that is in consumer defensive sector is not really doing well so far. If you look at companies like Procter & Gamble, Colgate-Palmolive, Clorox, they're all down double-digit this year. So there's a bit of a rut in this sector. Another one that could be interesting is industrial, even though those companies are usually paying smaller yield. You have companies like 3M that doesn't do very well right now. The defense aerospace, I just mentioned that in my newsletter last Friday. I covered them. They all lost double-digit numbers as well. So I'd say that probably that this is where you can find great buys, not necessarily high-yielding stocks though. So not much for their retirement focus. But and at the beginning of the year, we had the REITs and utilities, but those, they had pretty much catch up right now. So they're pretty much the same value at the beginning of the year than they were now. So I'd go with consumer staples and industrial. Definitely not tech stocks though. Peter, for Canadians that wants to buy US stocks, do you recommend having US brokerage account or buy them in your Canadian account? I think you're better off using a US account, which you can have a US account with your Canadian brokerage. But the point is, when the dividend is being paid, if you hold stocks in your Canadian account, the dividend paid will be automatically transferred in Canadian dollars, and then your broker will charge you like 2, 3, I don't know, 4% in currency exchange. What you can do instead is to have a US and a Canadian account, and when the US stocks pays their dividend, it's being deposited in US dollar in the account, and then you can use there's a strategy using an ETF, or you can buy an ETF, a US ETF, and then transfer it into your Canadian account, so you save on the currency exchange fee. Because this may not seem a lot, but if your portfolio is generating like $10,000 in US dividend a year, and you lose like 3% of that, I mean, this is enough to pay yourself a very nice restaurant, right? And a nice bottle of wine with that. So I'd rather go to a restaurant instead of giving that money to my broker. Bob, you're asking my thought on Gibson Energy. Not looking for buy or sell recommendation presently on this stock in my portfolio. Good question. I haven't taken a look at this one recently, but I'm gonna take it down and issue a stock card. We do have lots of stock cards requests recently. We had a lot of the new members actually because we had the retirement portfolio launch last month. So we're a bit of a backlog. I think we have now something like 80 or 85 requests that haven't been done yet. So we're going to try to make a push on this and try maybe to up from, we used to produce 5 to 7 new stock cards per week. To be honest, we'll try to jump that to roughly 10 if I can make it happen. My goal would be to go at 10 stock cards per week, new ones on top of the one that we review, to make sure we meet that demand, because now we have quite a backlog, but I've taken note on this one, and we'll definitely review it. So, all right, people, it's been an hour. Thank you for your time. I hope that we have provided value to you today, that you enjoyed this webinar. As I mentioned, I know this one was a little bit more general, but the next two will be a lot more technical. So sometimes it's good we had to start somewhere. Thank you, Mike. Thank you, Bob, Karen. Thank you for being there. So if you have any comments, suggestions about new webinars or topics, or, just something that you would like me to focus on later on, the way that we are able to improve the SR from quarter to quarter is from your feedback. So actually everything that all the new features that we add is because somebody somewhere asked for it. So don't be shy, send us all your ideas, just reply to any newsletter you receive on Fridays, and it will be my pleasure to help you out with our portfolios and stuff like that. So thank you, Rich. Thank you, everyone. And we'll see you in another webinar in September. Cheers.